If your company offers you a 401k, before you go out and you dump all your money into your 401k, I want you to pause for a second, because unfortunately, the vast majority of Americans who have a 401k know nothing about what they are invested in, the fees, or how they can grow their money the fastest. And if you stick with me here, you're not going to be one of those people. If you want to maximize the returns that you can get out of your 401k plan, there are 5.5 things that you need to pay attention to. Number 1 is you got to pay attention to the employer match. Number 2, you got to pay attention to the fees. Number 3 are the investment options you have. Number 4 are the taxes. Number 5 is what happens when you leave the company. And then the other half is 401k alternatives, which you definitely want to pay attention to. Now, what I do got to let you know again is that although I am a licensed attorney, I am not your attorney, and if you have specific questions, talk to a financial advisor, a licensed advisor in your area, because there can be a lot of nuances with your 401k plan, so talk to an advisor in your area if you have specific questions about your plan. The first thing that you want to pay attention to is the employer match. Does your employer give you a match with your 401k? Some employers might say that we're going to match your contribution 100% up to 2% of your income. Meaning, if you make $100,000 a year and you invest 2% of your income, which is $2,000, your employer will give you an additional $2,000 essentially for free into your 401k. Now, it's not technically free because you have to work to earn that money. It's a part of your compensation, but that's what a lot of people like to call it, free money. So let's just go with that term for this video, where you're getting this $2,000 essentially for free and it's being put into your 401k. This is where you want to first clarify what is the employer match and understand what you have to do in order to get that match. And if you're just starting off, start by matching that employer match. That way now you can get started as an investor. Now, personally, I don't invest in a 401k. I don't use tax-deferred retirement accounts. But before you go out and just start avoiding these because you think they're bad and evil, at least get started with something like a 401k. It's better to have a 401k than no investments at all. This is an easy and accessible way for anybody to get started with their investments. Once you get started, that's when you can start analyzing other investment options and decide in the future if this is the right investment for you. But if your employer is offering you a match, at least get started with that. And if you don't know what you want to do, or if you want to invest your money outside of a 401k, well, get that match, then start investing outside of a 401k, and now you can compare. Do you like the tax-deferred accounts like your 401k and the options and the control that you get here? Or do you like the non-tax deferred options like investing your money yourself? And now when you do both of them, that's when you can make that decision. So if your employer is offering you a match, number 1, see what that match is. And then number 2, at least contribute up to that match. That way you can get that quote unquote free money from the employer. And then once you start getting that free money, start investing your money yourself. That way you can see if it is worthwhile for you to continue getting that employer match or not, based off of the controls and the limitations that come with your 401k. The second thing that you need to pay attention to when it comes to your 401k are the fees. And interestingly, about 70% of Americans who have a 401k have no idea of what their fees are. This is according to the Consumer Financial Protection Bureau. And we covered this statistic actually in market briefs, because a lot of people have a 401k, but most people who have a 401k have no idea that they have to pay fees to have the 401k. So if you didn't know you had to pay a fee on your 401k, sorry to be that bearer of bad news. Now, if you do want to stay up to date on what's happening in the economy, what's happening with the latest economic trends, with the housing market, the stock market, that way you're not blindsided by what's happening, you can join Market Briefs for free. It's a free daily newsletter where my team is breaking down what's happening in the economy and the stock market and the housing market and everything in between. You can read it in less than 5 minutes every morning, and it's free. So if you haven't joined Market Briefs yet, you can go to briefs.co/market. That's briefs.co/market. And I also got the link for you down in the description below. What I want you to do right now is, if you have a 401k, open up your 401k plan and look for something called the expense ratio. This expense ratio is the fee that you are going to pay for keeping your money in particular funds. See, when you invest your money into a 401k, you're not investing in individual companies. You're generally investing into funds where now you have either a computer or a money manager managing these funds for you. Now, when these funds are managing your money, whether it's through a computer or a money manager, there's a fee that gets paid to that investment brokerage that is managing your money, the fund owner. And that fee is called the expense ratio. And so what you want to do now is see how much this fee is and see if this fee is worthwhile. Because now when you're paying these small fees, they're also compounding. You're working to compound your wealth, your investments, but your fees are also compounding as well. Which means if you pay a small 1% fee on your 401k, and you do this from when you start your investing career to when you retire, that small 1% fee can eat up about 25% of your total investment portfolio, which means a 1% fee can turn your $1 million investment nest egg down to $750,000. Yes, all from a just 1% fee, because your 1% fee is compounding year after year after year on every dollar of profits that you make. So you definitely want to pay attention to these expense ratios. And then if you're investing in funds that have high expense ratios, make sure that the returns that you're potentially getting justify the higher fees. This is where it's going to require that little bit of financial education as well, because you're going to have a few options of where you can invest your money. Some of these fees might be higher, some of them might be lower. And now you need to understand what is a good fund for you. There's a bunch of videos on the internet and articles that you can look into, which will help you understand that, but you need to understand how much that fee is actually going to cost you. There are calculators on the internet that you can also use, that you can plug your numbers in and see how much these fees will cost you depending on the types of returns that you get. This brings me to number 3. What are your investment options? Because every company now is going to have different investment options where you can invest your money, different types of funds, different brokerages, different companies that you can invest your money into. And this is where now the general rule of thumb is diversify. And what diversify means, you want to have money into different types of funds. Now, this concept of diversification really just depends on the person. What Warren Buffett says is that diversification is for people that don't know what they're doing. And what that means is, if you are just a passive investor and you don't really want to have to care about what's going on in the world, you just want to put your money to work and have it hopefully grow, then that's where diversification makes sense, because you're not keeping up with your investments. If you want to be more involved, then diversification can eat away at some of your returns. But this is where now understanding what are the options, what are the different types of funds. You can have value funds, you can have growth funds, you can have international funds. There's a lot of different types of things that you can invest in. You want to pay attention to the fees, but then also understand, what are you owning? This is what financial education is all about. And this could be an 8-hour long video or lesson right now about how do you find the right types of funds? What are the different types of funds? But the main thing that you want to understand, that I want you to understand here, is a difference between an actively managed fund and a passively managed fund. This is going to determine what the fees are. So I mentioned just a minute ago that your funds can be managed either by a computer or by a person. When a fund is managed by a computer, that's called a passively managed fund. When it's managed by a person, that's called an actively managed fund. Now, when it's managed by a person and it's an actively managed fund, the fees are going to be higher. Those are generally going to be like the 0.5% to 2% fees. When it's managed by a computer, that's generally going to be the 0.5% and less in fees. Some of them are going to be even less than 0.1% in fees. Now, the reason or the selling pitch for an actively managed fund is that this person can outperform the markets, that they can outperform the computers. Now, what we've seen historically is that most of the time, they will not be able to outperform the general markets. Does that mean that 100% of the time they're going to lose? No. But generally, that's what we see happen. There's always going to be exceptions to the rule. And so now, when you are picking your funds, you got to know what it is that you're investing in. If you're investing in actively managed funds, you want to make sure that the returns, the potential returns that you're getting, will justify the higher fee. If it doesn't justify the higher fee, then it might be better for you to invest just in passive funds. Some of these passive funds will give you exposure to the general stock market or to big groups of companies like the S&P 500, which is the largest 500 companies in the stock market. And the way that these passively managed funds work is that you build an algorithm. These funds will create an algorithm that says that this fund invests in the largest 500 companies in the stock market. And if one of the companies is no longer on this list, where they're no longer one of the largest companies, the computer will automatically kick that company out and put a new company in. That's why the fees are significantly less, because you don't have to have the money managers sitting there actively monitoring the accounts, versus with an actively managed fund, you need the money managers that are sitting there actively managing the money, which is why the fees are higher, and which is why you need higher returns to justify the higher fees. The fourth thing that you need to understand is taxes, because when you invest in a 401k, you'll have the option to invest either in a Roth 401k or a traditional 401k. With a traditional 401k, you pay taxes on the back end, which means you make your money. If you make $100,000 a year, you make the $100,000, and then if you invest 2% of that, $2,000, that $2,000 goes into your 401k untaxed. So all $2,000 $1,000 goes into your 401k that can be invested over the course of your career. And then if that $2,000 grows to say $200,000, you then pay taxes on that $200,000 on the back end at whatever tax rates are when you retire. The flip side is a Roth 401k, which is now if you make the $100,000, you're going to pay taxes on all of that $100,000, which means you might be left with 70 grand. Now, out of that 70 grand, now you invest, say, $1,500 as opposed to $2,000, and now this $1,500 goes into your investment account, and now maybe it doesn't grow to $200,000 like before. It might only grow to $150,000, but you no longer have to pay taxes on the back end when you pull this money out. The questions that you want to ask yourself are, number one, what is your income going to look like when you retire? Because the big selling pitch that a lot of people have with this is when you're 65 or 70 years old and you're pulling money out of your 401k, you're not going to have an income. So the tax rates won't matter as much. So if you plan on not having an income, then yeah, maybe that will work for you. But for me, that doesn't make any sense. I'm working to own investments, own assets, own businesses that will continue to grow my income. That way, when I get older, my income is going to be a lot higher, not lower than where it is right now. So to me, I don't like that. For me, a Roth would make more sense because of that. The second thing you want to understand is where are tax rates going? If you look at the macro economy, you look at the state of the United States government right now, the United States government is drowning in debt. We still have a large national deficit, and it doesn't look like a national debt is going away anytime soon. The way that the government pays off this debt is by taxes. They generate tax dollars from taxpayers. And so if our debt costs, our servicing costs are going up now because number one, we're growing our national debt, and number two, the interest rates on our national debt are also rising. That means the government is going to have to pay more and more money in interest each and every year. How are they going to generate more money in interest? Well, they're going to need more tax dollars, which means that there's a high chance, a high probability that taxes will at some point go up in the future. Will they for sure? I can't predict the future, but just based off of these numbers, it seems probable that taxes can go up. So now based off of that and based off of what we decided in the first point, what is your income going to be? You can now start to make decisions as to do you want to pay taxes in the end where we don't know what the tax bill is going to look like. We don't know what the tax rates are going to look like. We don't know what your income is going to look like. Or would you rather pay taxes today? For me, if I was investing in a 401k, a Roth would be my decision because that makes more sense for me. But you are not me. You have different goals than I do. You have different interests than I do. You have different hobbies than I do. You have a different projection on where the economy and your investment portfolio will be. So pick what's best for you. But those are the types of questions you need to ask when you're deciding between a Roth or a traditional 401k. And the fifth thing you need to think about when it comes to your 401k, which is very important, which is what happens if you leave the company. Because we talked about, number one, the employer match. Well, many times employers are going to put restrictions on that match, which means you have to keep working at the company for a certain number of years in order to actually keep that match. Because if the employer gives you this free money and then you leave 6 months later, many times the employer will say, oh, no, you don't get this money, you don't get the match unless you work with us for at least another 3 years or something like that. So you have to figure out what the vesting schedule is to see when you actually get to keep that match. And then you got to understand that if you leave the company, what happens to that 401k? Because if you just cash out of that 401k before you're old enough or eligible to pull that money out, you're going to pay a penalty. So what are the options? If you go to a new company that offers a 401k, you might have rollover options with the 401k where you can roll that 401k over. You might be able to convert the 401k into an IRA, or you might even just be able to leave the 401k as it is. But this is where you want to make sure you understand if you have a 401k at a company and you're leaving, you want to know, number one, what's going to happen to the employer match that you got. And number two, what can you do with the 401k that way you don't have to cash out of the 401k and pay a penalty? What can you do with that money? What are your options, whether it's rolling over to an IRA, rolling it over to your new 401k, or keeping the 401k there? That way you can protect the money that you have in this investment account that you work to build. And then we have point 5.5, which is what are the alternatives to a 401k and why am I personally not a fan of the 401k? Now, again, I don't recommend what I do to anybody. The reason why I am not a personal fan of the 401k is because you can get a lot of tax benefits outside of the 401k as well. The reason why people love the 401k primarily is because of the tax benefits and because of the employer match. The employer match is great because you're getting quote unquote free money, but again, you got to work to earn that money. But then you also get the tax benefits, which people love. Now, what's interesting is you can get a lot of tax benefits outside of the 401k as well. Like when I go out and invest in real estate, There's a lot of tax benefits that I get with real estate as well. Real estate offers a lot of tax benefits. I can tell you as an attorney that real estate has some of the biggest and best tax breaks that a tax code has to offer. What are these tax breaks? Well, number one, when you generate an income, you can take write-offs against that income. And what smart people are doing and what smart accountants are doing isn't asking what is a write-off. They're asking how can you make things a write-off? How can you make expenses that you have in your life, whether it's eating at restaurants, having a phone, having a vehicle, traveling, how can you make these things write-offs? Now, again, in order to be eligible for this, you want to make sure you're following the rules of the IRS. They have to be related to your business. They have to be ordinary and necessary for your business, which is why you don't want to play games with the IRS. They will throw you in jail and charge you huge fines. Get a good accountant to help you with this. But that's the first layer of tax breaks and write-offs that you get. The second thing is real estate gives you a deduction called depreciation, which means let's assume that you made $10,000 worth of profit this year. You have $10,000 in your bank account. You then get to tell the IRS, hey, I made $10,000 worth of profit, but I want to take a write-off because my property is 1 year older. Now, depending on how much your property is worth, you can potentially write off all $10,000 worth of profit, maybe a piece of that depending on how big the property is, not because you have to spend money on anything, but just because your property is 1 year older. This is called the depreciation deduction, which lowers your taxable income only because your property is older. And this still applies even if your property goes up in value. And then the third thing is the 1031 exchange. If you bought a property for, say, $100,000, and let's assume that it goes up in value to $500,000. It really appreciated in value because you bought it in a great area. If you sold that property, you'd have a lot of taxable income. You'd have $400,000 worth of profit and a big tax bill. But what the 1031 exchange says is that if you take all $500,000 and you go out and buy a new property, a bigger property that's going to pay you with more cash flow, you don't have to pay a penny in taxes today. You can keep flipping these real estate deals. You have to own it for at least a year, but you can keep flipping these real estate deals, deal after deal after deal, and never pay a penny in taxes, assuming you never actually sell and keep that profit in your pocket. Because now you keep flipping into bigger properties, which are paying you with bigger cash flow. So yeah, there are a lot of tax break opportunities out there outside of the 401k if you're willing to invest a little bit differently than what the majority of people consider an investment. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.